The RBA keeps the cash rate steady. Let's have a look. Hello everyone, Florian Heise here, stein of coffee in hand, and I thought we'd have a look at the RBA keeping the cash rate steady today. Now this aligns with the rate indicator probability from the ASX. 3rd of Feb, the percentage of no change was 72 and decreasing to 0.5 was at 28. And you can see from the 22nd of January, it's pretty much no change has climbed up to 72% from 42. So it oscillates every day. It's gone slightly down, but you can see here, this is aligned with what was predicted. So let's have a look at our governor's statement with regard to this monetary policy decision. And before we go, are you surprised that they kept it steady? Were you expecting it to cut? Were you hoping they would cut to help stimulate the economy? Or were you worried that it would overheat? Let me know your thoughts and opinions in the comments before we go into here. I'm not surprised they didn't cut. I'm kind of glad they didn't, because I would love it if we could get through this next couple of years without having to resort to QE. At its meeting today, the board decided to leave the cash rate unchanged at 0.75%. The outlook for the global economy remains reasonable. Reasonable, that's the board's favourite word, I think. There have been signs that the slowdown in global growth that started in 2018 is coming to an end. Okay. Did they see the iron ore price just fall? Did they see the decline in all the decline in economic activity from China affecting our country and all the others? We'll have to keep going. I'm sure they did. Global growth is expected to be a little stronger this year and next year than it was last year, and inflation remains low almost everywhere. One continuing source of uncertainty, despite recent progress, is the trade and technology dispute between the US and China, which has affected international trade flows and investment. Another source of uncertainty is the coronavirus, which is having a significant effect on the Chinese economy at present. It is too early to determine how long-lasting the impact will be. What about the impact that will have on the Australian economy? We looked at this morning, the crayfish industry is in trouble. We had, the ABC interviewing North Queensland crayfish farmers and fishermen, and surprisingly, well, not really surprisingly for the ABC, but, of course they were expecting a handout. I don't think they would have interviewed them if they didn't. Maybe I'm just being too cynical about the ABC. Maybe I am. Let me know if I am in the comments, guys. Interest rates are very low around the world, and a number of central banks eased monetary policy over the second half of last year. There is an expectation of a little further monetary easing in some economies. Long-term government bond yields are around record lows in many countries, including Australia. Borrowing rates for both businesses and households are at historical low levels. The Australian dollar is around its lowest level over recent times. And I think we were sitting at 66 cents the last time I looked. Maybe we jump back up to 67, and we'll just jump here. Australian US is at 67. So it's gone back up. The central scenario is for the Australian economy to grow by around 2.75% this year and 3% next year, which would be a step up from the growth rates over the past 2 years. How? How is that possible when GDP growth is going down? When consumer confidence is in the gutter, when we're reading about retail collapses all the time. I've got another video that I'll release later tonight about another retail collapse. When business and conditions and confidence are low. When our tourism industry is heavily dependent on Chinese tourism, and now they can't even land in the country. Not to mention university education. Where's this growth going to come from? Can someone tell me? So in the short term, the bushfires and the coronavirus outbreak will temporarily weigh on domestic growth. The household sector has been adjusting to a protracted period of slow wage growth. Yes, of course, because why do we even take the RBA seriously with regards to wage growth? Because they're so good at predicting it, aren't we? Anyway. And last year to a decline in housing prices, with the result that consumption has been quite weak. Following this period of balance sheet adjustment, consumption growth is expected to pick up gradually. Why? The overall outlook is also being supported by the low levels of interest rates, recent tax refunds, ongoing spending on infrastructure, a brighter outlook for the resources sector, and later this year, an expected recovery in residential construction. Why? I don't understand. I don't understand. Let's look here. Commodity prices, trading economics. We'll look at it now. Okay. Iron ore, 62%, down $14. Iron ore, down $13. Okay, I'll bring up Google Earth Pro, guys, and we'll have a look at the amount of mines that Australia has for iron ore. We're the biggest iron ore exporter in the world. Where's all our iron ore going? Okay, 20% of the exports here, what is it, $48 billion. It's all going to, I wonder, China, 35%. Okay, I'll bring up my Google Earth Pro, and this is the Australian mines data. Look at all these iron ore mines. If it hits $50, any hope for a surplus is gone. Because remember, our government is dependent on this one export that can affect the surplus. That can affect their royalties that much. Isn't that worrying? So where's all this coming from? The coronavirus outbreak will be a temporary weight on the domestic growth. How long do they define temporary? Is it going to be 1 or 2 years? How long till our tourist industry recovers from the bushfires and from people not able to fly here? The unemployment rate declined in December to 5.1%. It is expected to remain around this level for some time before gradually declining a little below 5% in 2021. Okay, that's if you trust the ABS statistics. If you look at the Roy Morgan statistics, it went up from 8.1 to 8.6. Wages growth is subdued and is expected to remain at around its current rate for some time yet. A further gradual lift in wages growth would be a welcome development and is needed for inflation to be sustainable within the 2 to 3% target. Sure. Okay, I'll just leave this here. I will turn this into a mug. I promise you I'll turn this into a mug for people to buy. That's on my next plan. Taken together, recent outcomes suggest that the Australian economy can sustain low rates of unemployment and underemployment. Yeah, because we're underemployed. Unemployed rates close to 20%. Combined with unemployment and underemployed, Roy Morgan data close to 20%. Doesn't that feel accurate? Inflation remains low and stable. Over 2019, CPI inflation was 1.8% and underlying inflation was a little lower than this. The central scenario is for CPI inflation to be around 2% in the near term and to fluctuate around that rate over the next couple of years. In underlying terms, inflation is expected to increase gradually to 2% over the next couple of years. I think inflation is going to go up higher than that if our dollar starts to decrease and cost of living goes up. There are continuing signs of pickups in established housing markets. This is especially so in Sydney and Melbourne, but prices in some other markets have also increased. Well, if we'll have a look here, you can see here, this is from the unit price growth. This is the red rooster line, essentially. You got all the hippie goat cheese places around the eastern suburbs. Everything to the west, the units are all decreasing in value. They're not picking up. Any property pickup we're seeing in prices is purely to do in the upper quartile. It's not spread to everyone. So this is especially so in Sydney and Melbourne, but prices in some other markets have also increased, but they've also decreased. You haven't said that. Mortgage loan commitments have also picked up, although demand for credit by investors remains subdued. Mortgage rates are at record lows, and there is strong competition for borrowers of high credit quality. Certain conditions for small and medium-sized businesses remained tight, or credit conditions. The easing of monetary policy last year is supporting employment and income growth. Well, no, you just said income is barely growing, and unemployment is still around 5%. How's it supporting that? It's artificially stimulating the economy. Anyway, it's in Australia, and a return of inflation to the medium-term target range. The lower cash rate has put downward pressure on the exchange rate, which is supporting activity across a range of industries. Okay, that sounds good. That sounds good. It does sound good. Let's have a look at what Australia is exporting. You know, good old colonial Australia exporting stuff back to the mother country and the superior civilizations with our fantastically advanced economy, 59th in the world. What are we importing? All of these things will go up. Petrol. Petrol's going to go up. All the consumer crap that we buy. Petrol goes up, food goes up. Food's going to go up because of the bushfires. Power's going to go up. Everything's going to go up, guys. With interest rates having already been reduced to a very low level, and recognizing the long and variable lags in the transmission of monetary policy, the board decided to hold the cash rate steady at this meeting. Due both to global and domestic factors, it is reasonable to expect that an extended period of low interest rates will be required for Australia to reach full employment and achieve the inflation target. So if we get used to this low cash rate, what's going to happen when they have to start turning it around? Are we going to start seeing more people in arrears? Are we going to see a continued property price growth and a continued property bubble, and the housing affordability just getting more and more out of reach out of normal people? You tell me, guys. Let me know in the comments. The board will continue to monitor developments carefully, including in the labour market. It remains prepared to ease monetary policy further if needed to support sustainable growth in the economy, full employment, and the achievement of the inflation target over time. And remember, inflation is essentially whittling away of your wealth to encourage us stupid plebs to spend. That's what it is. Let me know what you think about this, guys. I'm glad they haven't cut the cash rate, to be honest, because I can see it as just one step closer to QE. Let me know your thoughts and opinions in the comments below. Please like, share, and subscribe. If you're a fan and want to help us a little bit extra, we have a Patreon where you can make a monthly donation. You can also join the channel here on YouTube and get access to emojis and badges. We have affiliate links with Independent Reserve, Amazon, and eBay for your consumer purchases and crypto trading. We sell merch, pocket squares on the HeiseSays website. And finally, we've got PayPal if you want to contribute that way. Thanks to everyone who's supporting the channel, all of you who are watching and sharing the content. Really appreciate it. Take care, guys, and I will see you in the next video. Bye for now.